Many Saccos are being hit with additional tax assessment notices from KRA because of their lack to understand the difference between their taxable income from their non-taxable income, as well as their inability to tell apart between deductible expenses and non-deductible expenses. This may sound very simple, but for Saccos it is very different. And this mismanagement is causing them to suffer losses in terms of interest, penalties, and fines. And these are costs that can be avoided when proper accounting rules and procedures are followed and with good understanding of Section 19A of the Income Tax of Kenya. But let's start with the basics. What is a Sacco? A Sacco is a savings and credit cooperative organization which is a member-owned financial institution with the main mandate of mobilizing savings and providing cheap and affordable credit to its members. Saccos operate under the principle of cooperative ownership, where the profit it generates is shared among its members and not with external shareholders. According to Income Tax Act, specifically Section 19A, a Sacco has two types of income. Number one is taxable income. A Sacco generates taxable income when it does business with non-members. If a Sacco lends loans to non-members, the interest income coming from those loans is taxable income because it has done business with external members, members who are not its own members. If a Sacco owns properties and it receives rental income, it is supposed to pay taxes for that income, whether it is dividends coming from other companies that it has invested in. All that income is taxable. However, and number two, non-taxable income. This is income that a Sacco generates when it does business with its members. Loan. Any interest that is being earned by a Sacco from a loan that has been advanced to one of its members, that interest income is not taxable. Contributions in terms of savings that members make on a month-to-month basis to their Sacco, they are not taxable. And therefore, it's very important for the people in leadership of Saccos, the accountants and the board members, to understand that any income that a Sacco generates by doing business by itself is not taxable. If the two of us, we form an organization that is called a Sacco and we lend each other money, as long as we are within this organization, the interest that we charge each other under the Sacco, it is not supposed to be subjected to taxation. Now, how do we know which expenses to deduct when computing the taxable profit and which ones not to deduct? The key rule is that you only deduct expenses that were wholly and exclusively incurred in the process of providing taxable income. But those other expenses that were not used wholly and exclusively for purposes of producing or generating taxable income, they are not deductible. For example, any expense incurred by a Sacco in the process of facilitating or processing a loan to one of its members is not tax deductible. It should not be deducted from the taxable income of a Sacco. However, most Saccos deduct all expenses that they incur when computing the taxable profit, which is a big mistake, and that's why they find themselves with problems with KRA. Now, how do you compute the taxable amount for KRA. How you'd go about that is first understand what is the taxable income of this organization according to Section 19A of the Income Tax Act of Kenya. Once you have understood what is the taxable income, then isolate from all the expenses that were only incurred in the process of generating the taxable income. All that other expenses that were not incurred wholly and exclusively for generating this taxable income should not be deducted. For example, any expense that was incurred in the process of raising or advancing a loan facility to a non-member, that expense is deductible because it resulted in an income that was earned by the Sacco. So once you are able to arrive at the taxable profit, you apply the 30% tax rate that we use in Kenya to tax corporates, because also a Sacco is a corporate and its income and profit is subject to 30% corporation rate. Now, in summary, to avoid the risk of your Sacco being hit by additional tax assessments by KRA, always differentiate between taxable income versus non-taxable income. And once you differentiate that, you should also isolate your expenses into two groups: deductible expenses and non-deductible expenses. Deductible expenses are those expenses that were wholly and exclusively incurred in the process of providing taxable income. And we have said taxable income is any income that a Sacco generates by doing business with its non-members. But any income that a Sacco generates by doing business with its members is not taxable. Once you understand that, you will ensure that you are in good books with KRA, and by doing so, you protect the welfare of members and the interest of the Sacco, which is to empower the members who are registered with them.